Welcome everyone to an Industry in Transition Zoom call. I'm very pleased today to have Avy Stein, who's the founder of Cresset Asset Management. Was Cresset Asset Management, am I saying the right name of the firm there, Avy? I want to make sure.
Cresset Capital
Cresset Capital. There we
Cresset
go.
Asset Management is a part of Cresset Capital.
There we go. So, but the remarkable story, I mean, 0 to 12 billion in 3 years. I mean, fantastic. So I'm sure everyone's very interested to hear how you guys have been doing that.
Great. Well, I'm excited to be here, Tony, and thank you for your time. And I'm happy to tell our story. It's been a lot of fun.
Yeah, it has been fun, but it's been a weird time too. I mean, I want to start off, first with, crazy times we're in. Not just a pandemic, but political unrest. The markets have been real volatile. People are expecting a lot of changes going forward. New firm, even though tremendous growth, and you've been in the industry for a while, but how have you handled that sort of the impact of all that change on a new firm?
Yeah, it's been very, very amazing to me what's happened. So if you rewind to last March of 2020, we were facing an enormous uphill battle. We were a growth-oriented company with new offices everywhere. We were in the middle of an acquisition. We weren't sure we could keep the lenders in to get it done. But we didn't know if clients who were basically risk off would move, right? Because they were in a risk off environment where they were scared of everything. And we were concerned even about raising the capital to finish the acquisition. I look back now and we added 140 clients since then. $2.1 billion of AUM. We financed everything. We set out to raise a little bit of money. We raised a lot of money. And, the conclusion for me is that as people learned that they could work from home, as they learned that certain types of businesses were going to succeed, and mainly the family office clients that we have that are ultra high net worth clients to begin with, who have had businesses that were working. Now they're home and they're thinking about, okay, what am I tolerating? What's not right? What could be better? And I think that our story just resonated with them about something better. And so we actually accelerated our growth during the pandemic, which was very surprising to me and something I could never have predicted.
Yeah, I mean, I wouldn't have either. And in fact, didn't in the beginning for the first month, but I look back on my predictions come like April or end of March, beginning of April, and I was already starting to turn optimistic because of the resilience of our business and the advisors in it, and the general feeling of optimism, the closeness to the clients, and this Zoom technology that we're using now, which was been transformative.
Yeah, well, technology is often cost deflationary, and I think this will be enormously cost deflationary. And if you think about just what's happened, right? So look at multiples in the industry. I was so worried we were going to be buying at the top because we had this acquisition we were closing. It turns out that multiples have gone up 25, 30% since we closed that deal. It's really crazy. But that is the recognition that you identified, which is the resilience of this business. And the fact that it is so resilient is making it more valuable.
There's no question, about that. But there has been a proliferation of firms, right? So there's since, going back the last 5-6 years, people have realized that this is a good space, to be in. So when you look at, and for the people listening now, Crescent, people may know, you may not, sort of a little bit under the radar. How do you differentiate your firm?
Sure.
There's a lot of white noise, like everybody, how are you different than Hightower? How are you different, what do you say?
Yeah. So, it's so funny. I almost catch myself every time I do this, and whether I should do it or not. But if you're a golfer and you play golf and you watch stuff on TV, golf, or you read a golf magazine, you see this commercial for something called PXG irons. And it's Bob Parsons, who was the founder of GoDaddy, who later in life decided he wanted to develop a golf equipment company, which you can't even imagine what would motivate somebody to do something like that, knowing just how competitive it was and how low the margins were. But he did. And he came out with a slogan. And the slogan is, nobody makes golf clubs the way we do. Nobody, period. And I think what's different about Crescent is nobody did it the way we did it. No one does it the way we do it. So when I say no one did it the way we did it, we have invested, well over $100 million in our platform. We built a platform to be client first, fully aligned from the get-go. We started by building a business that was for clients, built for clients, by clients. Eric and I were the first clients. Eric Becker, my partner, and I were the first clients.
So that's interesting. So I mean, you and I had this conversation before a little bit, but it's you guys are thinking, we're high net worth guys. What did we want in a firm?
Correct. What were we missing? We're missing. And there's certainly great people out there doing a lot of great things. But what we didn't find was the combination of philosophy, which is invest like a multi-billion-dollar family office would invest. What would they have?
Right.
We got the ability to meet with the Bemberg family and see their portfolio and realize it was 25% of their portfolio was in stocks and bonds. The other 75% was direct investments in companies, direct investments in real estate, direct investments in private equity secondaries, credit. And only 25% was what most of our industry focuses on, which is stocks and bonds. So, what would a multi-billion-dollar family do? That was number one. Then building the business from the get-go with all four legs to the stool. And those four legs are what we think are so critical and so differentiated. First, of course, goals-based investing philosophy led by Jack Ablin, with great manager selection underneath him, great research, all that. That's what people think about, right? Stocks and bonds. Second piece being very diverse and deep family office services, everything from family governance and education, cybersecurity protection, healthcare advocacy, estate planning, tax planning, jet card buying, all that stuff, just like a multi-billion-dollar family would have. The third, for all their generations. The third being probably the most important leg to the stool, which is institutional quality private investment vehicles. So we have a fully built out team in private equity. We have a fully built out team in real estate. We have a fully built out team in private equity secondaries and in credit now. And we get, because of our scale and because of Eric's and my background in the private equity business, we get to look at things that others don't see. And, we get to invest like in Palantir pre-IPO. We get to invest in funds, like we have a joint venture with Crescent Capital, which is the biggest lender to sponsor deals, private equity deals. We got to invest not only as limited partners, but our clients got to be part of the general partnership. Right. They got to be part of the BDC. And there's several other examples like that. We created the 40 Act fund for private equity secondaries with a team from Landmark and Partners Group. So there's quarterly liquidity, and we solve the issue of broad-based diversification for private equity investing when people have previously had no exposure to private equity.
And that on the GP side, for an advisor that would join the firm, they'll have access to that stuff too. Is it accredited investor kind of vehicles, or is it just
Largely accredited investor vehicles. We can sometimes make exceptions, but largely accredited investor vehicles. And yes, of course, they will have access to that. And our clients, anything that we do, they get a very fee efficient opportunity. So, for example, in our private equity secondaries fund, our investors enter at 75 basis points versus the 125 basis points that other people are in at. Yeah. Similarly, in the, like I said, in the BDC, we own a piece of the BDC. We also do direct investing, co-investments alongside large private equity funds. So there's no J curve. They don't pay the fees. They just invest in the deal, and they pay the fees appropriate for the deal, which are less than what they would pay if they were in the fund. Yeah, right. So we create a lot of differentiated private opportunities. It's funny. I was talking to my own investment advisor within Crescent this morning. And we're launching a real estate income fund, which is a vehicle that's going to have not just stuff that we create, but a lot of things that we curate. And he said, that's not going as well as the stuff that we create. And I said, well, that's interesting. He said, yeah. He said, because it just doesn't have the same edge. It's just like people don't feel like they're getting something as differentiated as what we've created for them. So we have the largest, or the second largest, I guess, qualified opportunity zone fund in the country, in partnership with developers like Hines and Lennar and others. Yeah. And that's a great vehicle for our clients. And they get a discount on the fee structure and the carried interest for being our clients. So things like that make people very sticky and very interested. And
there's also an element, in my mind, what's going on with the stock market in general. You say stocks, most funds, they've invested in everything. They've invested in every stock. I mean, they're running out of things to buy. There's nothing,
Right.
and then the value goes down. And now we're in a situation where there's going to be more government regulation. They're starting to tell you what you can put in your RIA and what you can't. Now all of a sudden you're limited to index this and that, and we're in trouble when that happens.
Well, look, there's no doubt. First of all, there's half the public companies that there were 20 years ago. It is very hard to find alpha in the public markets. And we tell people, let's get the allocations right. Let's get you the exposure to the markets. But it's efficient beta is what we're looking for in the public markets. That doesn't mean we don't sometimes have active managers. It just means we're being as efficient as we can. Efficient beta, private alpha, deep planning. So that private alpha is a really critical element to what we're doing. And then the fourth piece, leg to the stool, that's the third leg. To go back to my 4 legs to the stool, the fourth leg, and I think it really is attracting a lot of people too, is especially for ultra high net worth investors. People pay $30,000 a year to belong to Tiger 21 or Family Office Exchange or any of those things. So we have events. We've done, tens of events, if not 100 events in the 3 years that we've been available, with great speakers, great peer-to-peer learning, great peer-to-peer events. We hired Jessica Malkin, who ran Chicago Ideas Week, to actually curate this whole suite of events. We thought they were all going to be in person. More recently, of course, they've all been virtual, but we actually built out our office space to be able to accommodate 100 people for an event. So hopefully we get back to that. But in the meantime, we're doing everything virtual. And people feel a part of the Crescent ecosystem. Yeah. If someone's selling a business, they will call Eric or me, who have, together bought and sold over 150 companies. They'll call us and say, what should I do to prepare to how to sell my business? We do that for people. We don't charge them. We do it. And it's just a very different approach. It is truly a multifamily office with all facets, like a multi-billion-dollar family would invest and serve.
This idea of the ecosystem, though, is, fabulous to me, because that in my mind, that's where culture comes from. And that's what, on different scales, I've managed different, $30 billion offices, right? And stuff like that for big firms. And you try to create an ecosystem. You do what you can, but with all these specialized products, it's got to be easier to be able to get the, family office. I think it's a different ethos, and having an ecosystem in that situation, in my mind, has got to be great for the culture of the firm. It's got to bring everybody together.
Yeah, well, it is. It is amazing. And you think about a couple of things. First of all, everybody at Crescent is an owner. Yeah. And those who are members of our ecosystem are largely owners. So our advisory board includes, people like Mayo Shattuck, who ran Alex Brown and now is the chairman of Exelon. So, Mayo's a terrific advisor, but also when we were looking at a software company that provides software to the space that Mayo is in, utility space, we were able to do diligence through Exelon. I mean, it all works together. It is truly an ecosystem. And because everybody's an owner, everybody is really pushing the same direction. Everybody is motivated to work together for the greater good. It's not, this is not a federation of individuals. What I say to people coming to Crescent is, if you want multiple ways to win, if you want to be part of something that kind of looks like the old partnerships, the old Alex Brown, the old Goldman Sachs pre-IPO, this is where you want to come, because you can win by building your own business, of course, and we're going to support you to do that. We're going to support you with huge business development efforts, all the ecosystem, all the events, digital marketing, all those things. But you also are going to get the opportunity, because you're an owner of a fast-growing business, to make as much money or more money on your ownership, hopefully a lot more money on your ownership, than even you could possibly make on building your own business. It's multiple ways to it.
Yeah. Well, you know what you did in journalism? We call that you buried the lead. That should be the lead. That's the first thing I would tell everybody. You know what I mean, Chief? Because
I tell everybody this story. I built my career. I started off as a lawyer, and then worked for clients running businesses.
We're not going to hold that against you. The law.
Yeah, I know.
Me too. I was a lawyer too. I'm completely reformed though.
It's even worse. I was a lawyer and a CPA, and I ran businesses. And then I was recruited to run the old Continental Bank's private equity business, and then I built a series of private equity funds on my own. And it really taught me a lot about where you want to go and how you want to create this alignment of interest. So when we decided to build this business, I wanted to be sure I did that. And I always tell people the following story. I was about 20 years in the private equity business, and a friend of mine finally decided to leave Morgan Stanley and start his own private equity business. And I was very excited for him. I introduced him to a lot of private equity funding sources. And he called me one day and he said he was going to partner with someone who came out of investment banking who had a boutique investment bank. And I said, really, why are you going to do that? Aren't you going to have to give up a lot of your carry? And he said, yes, I am. And I said, well, I don't know if I like that. He said, no, I think it's a good idea. I'll have multiple ways to win. Well, several years later, he made an awful lot of money on giving up half that carry because he had an ownership in an entity that was growing and became a very, very profitable business. That's what we're offering.
Yeah.
And you're not going to get that, going from wirehouse to wirehouse. You're not going to get that in a lot of small RIAs that don't have the panoply things. As I said, we've invested well over $100 million in our infrastructure. What we are building is something that's going to take advantage of the trend away from wirehouses towards RIAs, but it's also going to take advantage of the fragmentation in the RIA segment, because what we're going to provide is something that will be branded, will be full service, and as I said, by clients, for clients,
Scale.
like a multi-billion-dollar family.
Yeah, own some scale, actually be a partner in some scale, which is very hard to do, impossible to do on your own, as a practical.
Right.
But you said something, and so you're bringing these guys over. These are custom, these are bespoke deals you're doing for everybody.
Yes. We recognize there's a market out there, and we have to be, cognizant of the market. And we'll meet or beat a market deal. It'll just look different because it'll have ownership elements, and it will have opportunities for people to make a lot more money over time. But it's not just as simple as, well, I'm going to pay 3 times your trailing 12. It's going to be a structured deal that is, we think, much better for everybody.
Well, you need advisors who understand that, and a lot of them do. You look at, there are plenty of advisors that are leaving the wirehouses for nothing. I mean, literally for no deals. When I started my first, we didn't have a deal. There was no deal. It's just come and join us. This is going to be a better place for you long term.
Yeah, I want people to come who see the value in creating something great, who obviously are focused on serving their clients. And I always say when I have a conversation with an advisor, in the first 5 minutes is, tell me about, how you service my clients. Tell me about, your software. Tell me about all that. I feel great. And when I have a call, which the first question is, what's the trailing 12 multiple and what's my payout? I don't feel so great. So,
yeah, that call ends quickly. It's, there's I don't know how to say it on TV, although, I own this thing. I say whatever I want. We always had a no asshole policy everywhere I went. And if you have an advisor who comes and he's a jerk, I guarantee you his clients are jerks. It's always the way. And if you have a firm that's run by nice guys, they hire nice guys, and the clients are all nice. Everybody, you have a choice now. You don't have to scale up, have 1 million people. You just need a few good people.
We have a culture card that we started with, and it's all the things like your behaviors, what you're all about, alignment of interest, putting the client first. We say we believe in great people, which is basically the rule you just described.
Well, everybody should have that rule. And we talked about, in the beginning, we sort of hit on a couple things, and I'm trying to figure out what's next in our world, from your opinion. You mentioned the M&A sort of still moving in a good direction. I think it surprised all of us, beginning of the year. What's happening next there, do you think, going forward, 21?
So I truly believe there are going to be, 6, 10, 12, 14 nationally known, independent, multifamily office players that everybody will know who they are. There'll be some just pure asset managers, obviously, too. But in the family office space, which to me is certainly at least 5 million and up, and largely 10 million and up, but at least 5 million and up. In those types of firms, they're just going to be a few, and they're going to be of scale. They're going to be able to provide a higher level of service. So consolidation is going to continue. There's always going to be room for the mom and pop. There's always going to be room for somebody who says, I just want to do it on my own. No doubt about that. But I think there is going to be a move toward these high quality, very scaled, very service oriented firms, which is, we hope to be the leader in that.
So that's what's coming out. I tend to agree in general that the things that have started are not going to stop. You know what I mean? And particularly technology, that tends to push these things along. Fast.
Correct.
Things can happen faster than they happen in the next one.
Correct.
But things are going to change. Not just pandemic, and not just this weird political stuff we got going on, But certainly, look at the appointments were just made, more regulation, more regulation on our business. It's an anti-business or whatever you want to say. There's it's more regulation, period. And then there's the issue of taxes and things that may come, in the future that could, certainly, look, everyone in a family office is going to have this issue, but, everybody out there, all the advisors out there, they're going to personally have the issue and their clients. And, what if something happens with capital gains or carried forward? And, there's a lot of stuff out there.
Yes.
What are your feelings on that?
So I think it's just going to become much more important to have sophisticated tax and estate planning as part of your offering, and to be doing, first the governance stuff, which is, what are your goals? What do you want to leave? What do you want to do? But doing the sophisticated tax planning for everybody in estate planning, I think it's going to be more and more important. As far as the regulation,
you guys have it, right? So you've got
yes, yeah.
Family office product.
Yeah, we have estate planning, we have tax planning, we have tax preparation if people want it. We will do everything, including outsourcing if people want the preparation of their estate plan. We're not doing the estate plan, but we will hire the lawyers, make sure it's done right. We'll do all of that for people. We'll protect their cybersecurity. We'll make sure their healthcare advocacy is done right. We'll, all the above. But on the regulation side that you mentioned, I think it's kind of interesting. I think that we are going to go away from suitability standard, and I think there's going to be more pressure on a more fiduciary type standard, and I think that only plays into the hands of the private independent group, and I think that it's going to put pressure, even more pressure than already exists on the warehouses.
Yeah, and I think in general, in my mind, the future, the more I look at it, there's not too many ways to say it. But the good advisors, good firms are going to do better, and the bad ones, the emperor's going to have no clothes. When the market, hits the bed or whatever it's going to do, then the people who have been doing ETFs or whatever, and no management, no contact, they're going to be in trouble.
Yeah, well, look, I think if you're just thinking about the business as asset management, I think you're going to see a lot of fee compression. I think that to the extent that you're providing a much broader service for clients and unique investment opportunities, you're going to see a lot less of that. So I think that's going to sort out too. And, back in the private equity days, we used to have two sayings. One is do the right thing. That's always good business. And the other is you build every business like you're going to own it forever. Yeah. And I think those same things are true here today. I mean, if you're just looking to kind of, build something real quick and sell it, I don't think that's going to work very well in this industry, although, certainly that's happened. And I think that if you're trying to just, do the basic asset management stuff, I don't think you're going to be able to compete long-term in the industry.
I don't want to, we could talk forever about this stuff. But I want to give people a break and leave them wanting more like Jerry Lewis. But is there anything you wanted to say that I didn't get to, or?
Yeah, I think, the main thing I want to say is just, I think everybody should open their horizons as much as they can. I think what we provide and what others like us, it's not just us, can provide is a really unique opportunity to do great things for your clients, and keep an open mind, and don't be, I think a lot of people think in terms of, okay, I'm going to go from one warehouse to another warehouse, and I'm going to monetize my book. Think about ways that you can really create life altering wealth for yourself while doing the best thing you can for your clients and providing a broader set of services. That's what we're about.
Fantastic. All right, thanks for being here, buddy. Really appreciate it.
Thanks, Tony. Thanks for the time. Appreciate it.